Hello and good morning. Today we are talking about credit, guys. We're going to talk all about credit, a whole lot of conversations about credit today. So when it comes to buying a house, guys, you have to know this. You need decent credit. Whether that credit is perfect at an 850 credit score or at least in a range that is acceptable by the banks. So when it comes to credit, there's a lot of different ideas of what's the best credit and what's the worst, okay? We'll start at the bottom. I talk to a lot of people on a daily basis, and they often share that they don't have great credit. And most of the time, these people are somewhere between 600 and 680. They could be 660, 640, 630, somewhere in that range. And they're like, we don't have the best credit. I'll let you know right now that if this is your credit range, you can probably buy a house. Because the minimum credit score guideline for FHA is 580, and Fannie Mae has just recently released back in November 15th, I believe, that they no longer have a minimum credit score. What? That's insane. So now you get an opportunity to either go Fannie Mae, which is conventional, or FHA with 3.5% down. So minimum down payments, okay credit score will get you into a house. But let's talk about how you should be managing your credit, because I think that's the best place to start. So anybody who's watching this right now, ask questions in the chat. Let me know what your thoughts, questions, comments, concerns are, and I will address them here live. We're giving you home buying tips. I'm Chris Dominguez, licensed loan officer, talking about mortgages, giving you the tips and tricks and all the inside information of what it takes to become a homeowner. But today we're talking about credit, okay? So when it comes to credit, how you want to manage it is by showing the bureaus that you have discipline. That's the key. You have to show the bureaus that you have discipline. And you're going to say, how do you do that? What do I call them? Do I talk to them? No, that's not what you do at all. What you do is you get a credit card, okay? And a lot of people are like, well, I don't want credit cards. Well, you need credit cards. If you're a living, breathing human being in the United States of America and you want to have, a great credit score, whether, 700, 800, 850, you need credit cards. And here's the reason why. When you apply for a credit card, it goes to your credit history and it kind of looks at it and goes, okay, how does this person manage their life? How, are they really responsible? Do they have discipline? Okay, they do. Here's your very first credit card, $300 max. You can take this bad boy and you can go buy watches and gas and food and whatever you want with a $300 max, okay? Now, here's how you show if you have discipline. Once you get that credit card, okay, let's say it was issued February 7th, 2026, okay? Let's say it was issued that day. Once you get that credit card, what do you do? How responsible are you? What kind of discipline do you have? Because you can, on that very first day, take it all the way to $300. That very first day, take it all the way to $300, which means you can buy yourself a TV. You can buy all the groceries that you can for $300, and now you're max. And so when the credit card reports in March, they're going to go, okay, let's see how Chris was acting in February with his credit card. What? We give him a $300 max, and he already used it all? He already used it all? Okay, this guy's not responsible. This guy has no discipline. So wherever my credit score was at, okay, wherever it was, let's call it a 650 with a $300 credit limit, it is now a 620 or 610 or 625, somewhere, it's less than it was before. And here's the reason why. When you have a maxed credit card, you now have zero available credit. Zero. And if you have zero available credit, but revolving credit cards reporting on your credit report, it shows you have no discipline. You're basically just telling everyone, I have maxed credit cards. I have no discipline. I max my credit cards. And that's not what the credit bureau is like. So your credit scores go down. Now, let me give you the second scenario, okay? And this is over time. This isn't immediate, but I'm just giving it to you as an example. I get a brand new credit card with a $300 credit limit on February 7th, 2026. $300 credit limit. And I go, holy cow, my first credit card, $300 limit, Sky's the limit for me. I can go party and have a good night with this, but I'm not gonna, because I may need this. I may hit hard times and I may not have cash in my bank, and I may need food. I may need gas. This is just for emergencies. This isn't for vacations or party nights. This is just for emergencies. I don't need a new watch or clothes or cologne or whatever it may be. This is just for emergencies. Now, fast forward to March. The credit bureau goes, all right, let's see how Chris held himself with his credit card this month. And they go, holy cow, $300 limit? This guy could have went crazy. And it's zero. This dude is responsible. So what I'm telling the credit bureaus this time is, I have the ability to access $300 if I choose, but I'm not choosing it. I'm just going to leave it right there. If I need it, it's there. If I want it, it's there, but I'm just going to leave it for now. Don't need it. So what happens with your credit score is you have basically 100% available credit, 100% available credit. You go from a 650 to a 670 or a 680. You get what I'm saying? The more available credit you have, the better your credit score, because it shows you have discipline. Now let's change the numbers. Let's say you're now, Chris during that time was 25 years old, but now Chris is 40 years old. Okay, Chris is 40 years old. That $300 credit limit is now a $30,000 credit limit, along with a few other credit cards, 10,000 here, 5,000 there, 20,000 there. All these credit cards, right? With all these high limits, we're talking $50,000 to $100,000 in available credit. Okay. Now, first scenario, let's take it back to the first scenario. Chris has $50,000 available credit, but he maxed all his credit cards. Whatever his score was now is in the low 600s, maybe even 500s. So the more available credit you have that you use, the harder your credit falls. Okay. Now flip it to the other side. $50,000 to $100,000 in available credit, but it's all available. The credit bureaus look at it and go, holy smokes, this person can go out and buy a brand new car. This person can go on the best trips the world has to offer on vacations. This person can go buy a Rolex. This person can do so many things, but chooses not to. 800 credit score, 780 credit score, 825 credit score. So the more available credit you have when it comes to credit cards, the better your credit. So even if you haven't had any lates, let's say you've managed yourself pretty darn good when it comes to making your payments on time, credit card payments, car payments, whatever it may be that you owe to a bank, you're doing a darn good job of paying your bills on time. But your credit cards are maxed. Your score is going to be low. It's going to be low. It's not going to be, it may not be in a spot where you're not qualified for a house, but it's definitely not going to be where you want it to be, because the higher your score, the easier it is to get approved. And the higher your score, typically the better the interest rate you get. And that's what most people want, because you could be a really responsible person with maxed out credit cards. Well, I wouldn't say that responsible, but responsible on making your payments on time and maintaining great credit. But you don't get the best credit. You don't get the best interest rate, or maybe you're not even able to get approved at all, because what comes with credit cards that have balances? Payments, monthly payments. So if you have $50,000 in maxed out credit cards, you're probably in the neighborhood of, let's see, $1,500 to $2,000 a month in monthly payments just on credit cards. No bueno. Not a fun spot to be in. Not a bad spot to be in, but not a fun spot to be in. Now, the other person that has $50,000 in available credit has no payments. So now they have a 780, 800, 820 credit score, no monthly payments. This person's going to get approved. I would say that person's already approved. We just have to figure out how much they qualify for, how much house they can buy, 200,000, 500,000, a million, 1.5, whatever it may be. That person is already approved. Okay. So when it comes to credit cards, that's the biggest thing that's either really helping or hurting. But know this, guys, credit cards are necessary. They're necessary to fool the algorithm. And you're not really fooling it, because if you're a disciplined person, you weren't going to use them anyway. But you got them and you need them. You also need to maintain credit cards. I found this out personally, that if you don't exercise your credit cards, they will take them away from you. So I'll give you an example. You got that $300 credit card that you never use. Okay. Let's say months go by, maybe even a couple years. Every bank and institution runs a little bit different. But if you don't go put a tank of gas or buy some food or do something with that credit card, you have to use it. The whole use it or lose it is a real thing. They will close that card away from you and you will not have access to those funds. So you do need to keep that bad boy alive. So you need to go put a tank of gas. That's what I tell people. Once a month, fill up your car with it, pay it off immediately, and then keep moving forward. That's another question that I get too, about paying off your credit cards. So a lot of people have the assumption that being at 30% or 20% on your debts, on your available credit versus the amount that you use. Okay, try to clarify what I'm saying. Let's say you have $1,000 limit, but you only have a $300 balance on your credit card. Okay, $1,000 limit, $300 balance. That's 30% utilization. So a lot of people talk about having 30% utilization in order to have the highest credit scores, and that's not necessarily true. If you have all your credit cards maxed out, the goal is to get them down to 30% utilization, but you're not trying to take your zeros up to 30, okay? So if you're at 50%, 60%, 70%, and you're trying to get approved for a house to get your credit scores to the highest possible realistic spot, you do want to bring them down to 30% utilization. Some people say 20, but here's what I recommend, guys. Don't guess this stuff. Don't guess it. Call us. We'll talk with you about it. We actually have simulators that I can simulate your credit card and your whole credit scenario to figure out how much you really do need to pay them down to get the highest possible score. And it could be less than you think. Like, let's say you're 100% max and you're trying to pay it down to 30. Well, maybe it's not 30. Maybe it's 50 on this one, 30 on that one, 60 on that one, 20 on that one, which would save you a lot more money than bringing everything to 30. So don't try guesswork. Don't just listen to us crazy guys on YouTube. Talk to us. Give us a call. Let's have a conversation about your exact scenario so we can point you in the right direction and actually have success at the end of the day. Because that's the name of the game, guys. It's not getting a better credit score overall, which is a piece of it. It's getting you into a house. My goal is to get you into a house, whether it's today, a year from now, 2 years from now. I've conversated with clients for years before they became homeowners, literally years, because they were getting themselves in the right position. People that had real challenges, people that have lost jobs or mounted with debt, had foreclosures, bankruptcies, literally years. And then they're like, Chris, we're ready. Like out of nowhere, I just forget, Tom from down the way I spoke to him in 2016, and he's like, and I put him on the path, and I said, hey, here's what you need to do. This is what you need to do with your credit, your income, your assets, yada, yada, yada. And then 6 years later, 2020, I think 2 or something like that, he's like, I'm ready. And I'm like, holy cow, I'm happy you remembered me. And I'm more happy that you executed the plan and were successful at it. But anyway, I digress. So when it comes to credit, we spoke about credit card utilization, and we spoke about how that affects your credit score. Now let's talk about what credit does as far as programs. Okay. So a lot of people are very interested in the down payment assistance programs. So when you buy a house and you borrow money from a bank, part of the agreement is that whatever that house costs, you pay for. Okay, whatever it costs, you pay for a small percentage of that house up front. And what that is called is a down payment. Okay, so let's just say that your house costs $500,000 and you're putting 20% down. Okay, $500,000, you're putting 20% down. That means you have a $400,000 loan, but that $100,000 paid down from 5 to 4. That's where that down payment comes in. Okay. And a lot of people like the programs where the bank or or the state program or the county program or the national program cover that 20%. Not a real thing when it comes to Fed, but it is a real thing, and not a real thing in all states, but it is a real thing in California, because in California we have a program called the Dream Program, Dream for All, California Dream for All. And it's a program that's sponsored by CalHAFA, which is a California only program where they will give you up to 20% down on a property. Okay. Now, it's not free money, guys. It's not free money, but I don't want to get into the details and the guidelines of the programs. What I do want to do is get into the credit scores needed for these programs, because a lot of people, this is the only way they're going to be able to become a homeowner, is using one of these programs. Now, I know, and I tell all my borrowers this: if you can pay your own down payment, afford it, be comfortable, and buy this house, do not use a program. Do not use a program, because these specialty programs all come with catches. Now, they're not bad. They're not bad at all, because if it's the difference between you owning a house and never owning a house, and you have to use this program, then 100% move forward with it. This is what you need. This is how you're going to be able to build a legacy and pass it to your family. This is how you're going to be able to establish a place where your family becomes familiar with the consistency of, where are we going for Christmas? Well, grandma and grandpa's house. Where are we going for Easter? Grandma and grandpa's house. Where are we going for Thanksgiving? Grandma and grandpa's house. So you build that into the family, and that's a very big deal for a lot of people. Okay. A lot of people don't like hosting Christmas out of an apartment. Okay. And for those that have to, I get it. We've all been there at one time, and I'm not disrespecting them at all, but having a home for your family to be in and share memories is a huge deal. So if that's what you're looking for, and if it takes one of these programs to get there, I will guide you through and help you with it 100%. And for that reason, I love the programs. I love the programs. I'm talking about those that can afford to go traditional and not use the programs, but still want to. In those instances, you have the money and you should use it, because it's going to give you a better interest rate. Okay. A better interest rate, better terms. On some of these down payment assistance programs, you have to pay it back, or you have to live in the house for a certain amount of time until the money's forgiven. And that's the grant programs. But I digress again, because I'm not here to talk about the guidelines of the programs. I'm here to talk about what it takes as far as a credit score. Okay. And here's what it is. If you want a program that's going to help you with the down payment, if you want a program that's going to help you with down payment and possibly closing costs, the magic score is about 660. Is 660. Once you hit 660, it unlocks pretty much all of them. Okay. And there's a lot of them. And a lot of them do the same exact thing. Some are a little different. Some give you, like I said, grant money, which is forgiven over an amount of time that you live in the house. Some is paid back after you've paid off your loan or you've refinanced or sold. Some is paid back during the process of you paying your mortgage. So they're all a little different, but they all unlock at about 660. So there's your magic score. If you are the person who needs one of these programs, aim for a 660 credit score. And if that's where you're already at, then you're golden. You're ready to buy a house. We just have to figure out how much you qualify for. Because at a 660, you're getting approved. You're getting approved. I'm very confident that at a 660, when I go through everything, the bank's going to go, yeah, why would we not lend this person money? Now, are you going to be approved at the amount that you want? That's the question, because everyone wants $1 million to buy a house, but some people only qualify for 100,000, and that's not close to what you want. Now, whole other conversation. Once again, I don't want to try to get too far off of credit, but I do want to share with people, the challenges that we run into. And that's, yeah, you qualify. Yeah, you have a job. Yeah, you make okay money. No, you can't afford the house that you really want. You can't. I really want, certain cars, certain watches, certain things in life. But I look at my bank account and see the way my bank account works is, I'm just kidding. So when it comes to getting qualified for a house, a lot of people are qualified. The amount that they get to borrow to buy the house may not always meet the needs, but we have strategies and plans to get you higher amounts too. So one-on-one, we'll be able to talk about that and let you know what you can and can't do in order to get to those amounts. But back to credits. So 660 credit score or better will unlock mostly all the down payment assistance programs. Now, there are some that are a little lower. You can get into some at 640, but that doesn't unlock all of them. So you may not get everything you need at 640, but it may give you what you need. So don't hesitate if you're not at a 660 and you're watching this video, but you are at a 640 and you're like, oh, I can't do something because I'm at a 640. Wait, I can do something. Yeah, inquire, because you might be able to move forward today. You don't know the benefits of that 640 program. And like I said, I'm not going through the guidelines and the benefits of programs today. I'm more focusing on credit so that you have a good understanding of where you need to be. Okay. Now, when it comes to credit, I know I keep saying that, guys, but when it comes to credit, this is an important thing that you guys need to protect. It really is. It kind of sucks. And a lot of people have come to me over the years and said, this is not legal and this is not right. And we need to do this and we need to do that. And I agree with a lot of them. They're like, the FICO model is a scam and this and that. And in some ways, I agree in some ways. But it is the current system that we're in order to determine, for the banks to determine if you're worthy of borrowing money. I mean, that's the truth. And a lot of people, and here's what I don't understand. This is what I really don't understand, is a lot of people do not manage their credit well at all, almost as if they don't care. Lates on their credit cards, lates on their car payments, lates on their installment loans, lates on their student loans, lates on loans across the board. Not like they had an accident one month, because we all do that. I mean, occasionally it happens in our life. We get a little busy and life takes over, and then you're like, oh, crap. Now I got a late. Okay, so that happens. I get that. And that's, in some cases, that's allowable when you're going to buy a house. The bank looks at it and goes, yeah, that was an anomaly. That's not how you carry yourself. That's just something that happened in a moment. It was just a moment of time and it passed. And yeah, you're fine. We're not going to ding you for that. You're still able to buy a house. But for the person that's the way they manage their life, like, they're not getting a house. They're not getting a house. So there's a new guideline put out by Fannie Mae. Fannie Mae is a conventional loan, the most popular loan used across the nation for financing and buying houses. Okay. You hear mainly conventional, FHA, VA. That's what you mainly hear. Okay. Those are the three vehicles that are used the most for people to buy a house. Fannie Mae is probably number one. Okay. They recently made a guideline change that said that they no longer have a minimum credit score. So for years, for the longest, as long as I've been in the business, their minimum credit score was 620. So you needed a minimum of 620 credit score to be able to finance a house using Fannie Mae. Okay. Now, I put out that news, I think, on November 16th. Okay. November 16th, I put out that news where you found us on social media here, and we're all over social media. So we're always putting out stuff. And what I put out was that Fannie Mae made a change, guys. This could mean the difference between you never buying a house and buying a house. They no longer have a minimum credit score. Used to be 620, no longer the case. So everyone with a 400, 500, less than 620 credit score came out of the woodwork at me and said, you mean I could buy a house? I could buy a house? And I'm like, maybe. And then after about a couple hundred of credit pools of people having 460 credit scores, 480 credit scores, 520 credit scores that manage their credit poorly, I realized, oh, this isn't made for someone who has low credit. This is meant for someone who had a hard time and has bounced back, but still has a low credit score. That's who it's made for, not for the person that manages low credit overall, which is what I believed at the beginning. I didn't really think about it when I was putting out that message, and I should have qualified it with that, because everyone who has crappy credit, everyone that has crappy credit came out and was like, I could buy a house. I could buy a house. I'm like, you can't even pay your $20 a month credit card, bro. What makes you think you're going to pay a mortgage payment on time? And that's the people that aren't going to get houses. So here's what it's meant for, guys. So no credit score minimum credit score requirement on Fannie Mae, here's what it means. Okay. So today we're in 2026. So listen to this timeline. Listen to this timeline. And it doesn't have to pertain to COVID, but just listen to this timeline. So COVID hits in 2020. A lot of people were holding on for as long as they could, but hit hard times because a lot of us couldn't work. Some of us were business owners and we had to shut down. And you remember all the lockdown BS that was going on. Well, then what happened is we ran out of money, and you had credit cards that were due, and you had car payments that were due, and you had installment loans that were due, and you didn't have the money to necessarily pay them all. So you did the best you could to manage it. You were late on some, you were late on more, you were late on a lot. Before you knew it, you were buried and you couldn't make the payments anymore. You went into collections. Some of you were chased, maybe even being sued by the banks to try to collect their money. But that only lasted from 2020 through, let's say, 2021 was another hard year. 2022, you started rebounding. And then 2023, things got better. Okay. Things got better. By 2023, you were able to start paying all your bills on time. You no longer had lates. The last lates were in 2022. Okay. And then 24, same thing. Still able to pay your bills on time, still able to make ends meet, still able to, fulfill your obligations. 2024, same thing. 5, same thing. 6. Now you're at 26 and you go, hey, that Chris guy on YouTube was talking about no credit score on the Fannie Mae loan. I have a 525 credit score. I've been paying all my bills on time since 2023. So I have 3 years of solid on-time payments, but I still have a 525 credit score. That's who it's made for. It's not made for the guy who that's how he lives. Always late, always late. That the probability of that person getting approved is slim to none, unless that person has a boatload of cash, because there's 3 legs to a loan, guys. It's income, assets, and credit. If one of those is weak, the other one or two must be extremely strong. So if you have a low credit score, okay, but you have a bunch of cash, just a bunch of cash. Let's say you're buying a $500,000 house, but you have $200,000 in cash. You're going to put $100,000 down. You'll still have $100,000 in the bank, and you make a lot of money. Like your debt to income ratio was way low. Then you might have a chance if you have weak credit and you're still paying your bills not on time. Then you might have a chance. But other than that, uphill battle unless you change your lifestyle and the way you operate. It's an operating problem. It's not a credit problem. It's not a loan problem. It's not the bank or the loan guy's fault. It's the way you operate. It's going to be a challenge for you to get to buy a house ever, if possible, ever. But for the rest of you who actually are maintaining good credit and have a low credit score because you hit hard times in the past, but for the past couple 1, 2, 3 years, and you've been paying your bills on time and you've kind of rebounded, but you have a low credit score and now's the time to get in, that program is for you. No credit score minimum. No credit score minimum. So that technically means that you can have a 400 credit score. I think the lowest credit score is 350 and the highest is 850. Okay. So if you're under that 620 mark and are thinking you can't buy a house, you might have an opportunity. And then there's FHA. Okay. FHA 580, as long as you have your bills paid on time for the last 12 months, 580 or better, you're still getting with 3.5% down. I love FHA. FHA is probably the easiest loan to get qualified for. And then here's another one. Let's say that you can't go conventional for whatever reason, but you have a 500 credit score, 510 credit score, 520 credit score, and you have a big down payment. You have like 10%. If you have 10% or more, FHA will give you an opportunity too. So there's a lot of different ways to go, guys. I hope this helped. I hope this is what you're looking for when it comes to getting data on buying a house. Know this, guys. Our goal is to give you all the information so that it gets you ready to get to that point. If you are interested in becoming a homeowner and you'd like to talk with us, I'm going to put our phone number in the chat so you can Give us a ring when you're ready. It should also be in our description, in our bio, all that stuff. So our phone number is not hard to find. But we would love to help you get a home this year, get you on the right path. And who knows, maybe you're already qualified. Most people don't know this, but they're qualified without even having to go through the hoops, because their scenario is much better than they think. But I hope you enjoyed this. I hope to see you guys soon. If you want, give us a call. We'll see you. Have a great day.